Good evening, everybody. Good evening, traders.
Good evening, sir.
Good evening, sir.
You are welcome to the webinar tonight.
Thank you, sir.
I'm super excited having you guys here today. How's the week been?
It's been great.
Not bad.
Okay, so I'm still waiting for other people to drop by. Let me welcome everybody as I can see. I can see you, Colinus. You're welcome.
Thank you very much.
Felix, you're welcome. Roland,
Thank you, sir. Thank you, sir.
Adewale, you're welcome. Galaxy, you're welcome. So many people to welcome. Anyway, all right, so we've hit 20 already, while others come, they join. So I will first of all have to mute you all so that there wouldn't be distractions, right? I've just muted everybody. Please do not unmute yourself so there wouldn't be distractions, okay? Just make sure you listen. Whenever you can hear me, you just turn on your mic and tell me you can hear me and turn off immediately, all right? So we are here because we want to learn boom and crash. We want to become experts in trading the boom and crash. We want to become profitable in trading the boom and crash market, right? So what I need you to do is, number one, be attentive. Number two, make sure you have your Forex trading notes by your side with your pen, because everything I'm going to say, you might not put everything in your head at once. So you might need to jot some things down, okay? A time will come when we get into calculation, so you also need to make sure you have your calculator with you, okay? So today we are going to deal more on theory and less on practical. Then tomorrow is going to be all through practical, all right? So first of all, I'm going to take you straight to my presentation. Let me see, I'll share my screen. Okay, I hope everybody can see my screen right now. So please, if you're not seeing my screen, you just turn on your mic and let me know. But if you're seeing it, remain muted. So I'll go straight to this. All right, all right, all right. So the ultimate guide to trading boom and crash synthetic indices, that is what we are all here to learn. Okay, so let's listen attentively. About boom and crash. Boom 500 and crash 500 are synthetic indices, all right? Of Forex trading, these are markets that ticks based on simulation from stocks. When we say when we say simulations from stock, we mean imitation. All right, they work kind of like the same way or a little bit how stocks also work. All right, but one thing that makes boom and crash more special is that a lot of companies, all right, a lot of companies are involved in this market because this is a very dicey market that is kind of difficult to trade. But when you have the ideas of trading it, you get to see how easy it could be sometimes. All right. I'm not saying it is going to be easy forever, but sometimes it could be easy, especially when you are trading it in the right way. All right. Let me admit other people that are just coming in. Now, take note that this uh, webinar is being recorded. Okay. So, whatever you don't get well, I'm going to make sure that after the webinar, you guys are going to have the video to rewatch later. Okay. So I made it to be that every 40 minutes, the Zoom is going to cut everybody off. All right. What you need to do when you're being cut off is go straight to the group, click the link the same way you came to join the webinar right now. You rejoin again. All right. I don't want one video to be so long. So every 40 minutes, the video is going to be cut short. So you guys are just going to go click the link and join again for a new continuation from wherever we stopped. Okay. So after it, there's gonna be a Google Drive where I'm gonna upload all the videos of every training we're gonna have built both today and tomorrow. So you can always go and rewatch. All right. So boom and crash are synthetic indices that is found only under the Deriv.com platform. All right. A binary brand platform. So a lot of people always ask me which other broker sponsors this. No other broker for now, only the Deriv.com. Okay. So how to trade boom and crash indices successfully. A number of traders, both experts and beginners, have had issues with the market structure of boom and crash. And this is because, unlike the currency pairs, boom and crash have been structured to either buy or sell using spikes at even period of ticks. And that is the difficulty. That's the thing that blows a lot of people's accounts, the spike of a thing. And that is the reason why you are here today, because you want to learn how to retain your account and learn how to make the money out of this boom and crash market, right? So for instance, when trading either the boom, let's say the boom 500 or the boom 1000 assets, you will observe that the boom market sells with by default with candlesticks, right? And then it buys with what? A long bullish spike. That's how the boom market works, both boom 1000 and boom 500. Let me accept other people that are just coming in. All right. So if you try to observe that, that's what you get to see. And while in the crash markets, all right, the asset buys by default with candlesticks, and then what happens is spikes downward with a long bearish candlestick. All right. How to trade? Okay, let's keep going. Now, this is a very clear picture of how the boom and crash works. Now, this is a boom. It has candlesticks, and then what happens in a very strong bullish move, it spikes upward. All right. And the same thing applies in crash. By default, it takes candlesticks upward, and then bearishly it spikes downward. I'm having issues with Henry and James joining. I don't know, maybe it's their network or so. All right. So what are ticks in boom and crash? What are ticks in boom and crash? A tick is a measure of the minimum upward or downward movement in the price of a security. A tick can also refer to the change in price of a security from one trade to the other. All right. When we observe in the market, all right, when you are in the market, you observe on the right hand of the chart, you see the prices there, all right, those numbers you see, and then suddenly you see the digits increasing or decreasing according to the movement of price. All right. So those movements of those digits are what we call ticks. All right. Those movements are what we call ticks. In other words, we can also say a tick is also similar to what we call pip in the main forex markets. All right, when you hear people say 10 pips, 20 pips, and 100 pips, a tick is also similar to pip in the forex market. So a pip is an acronym for percentage in points or price interest points. Okay, so and it represents a tiny measure of change in the trading market. It is the smallest price move that a trading position or signal can make. Okay, so today you will discover top secret of boom and crash, top secret that boom and crash traders don't pay attention to, and that's the reason why they fall into loss traps. Number one, we need to understand. Number one, we need to understand that why trying to find out uh, why traders become unsuccessful. I discovered that trading psychology is one of the issues in which many traders do not pay attention. Your trading psychology, when we talk about trading psychology, we're trying to talk about your, let's say, your feeling, how you feel when trading, all right? When you're running loss, how do you take it? When you're running profit, how do you take it? All right? There are people who, not even there are people, almost a lot of people, all right, especially new traders, all right, who are just joining the market. When they see themselves running a loss throughout that day, their mood changes. When they see themselves running loss throughout that day, their mood automatically changes. In fact, if you come near them and say something stupid, they could give you a slap just because they lost $5 or $10 or they blew their account. That is what we mean your trading psychology. You should learn to understand. You should learn to control your emotions when you are in the markets, because your emotions have a long role to play while trading in the markets. All right. Uh, when you are in good emotion, or we'll say when you are in good emotion, okay, you can take trades. But when you find out that you're not in a good emotion, it is advised that you don't take a trade. Don't even get into the market. All right. You don't get into the market. You allow yourself to have a rest for that day until when you are comfortable to take trades, emotionally comfortable, psychologically comfortable, and otherwise. Okay. So it is not all the time that you should trade as a trader. It is not all the time that you should trade. Before you take a trade, you ask yourself, am I ready to take a trade? Okay, because it's gonna deal with your psychology when you're taking the trades. When you run in loss, you must learn to control your emotions. And also at the same time, when you run in profits, you must also learn to control your emotions. Why do I say so? A lot of times you get to see that people or traders take trades, and when they are trading and they are running in profits, suddenly what do you see? You suddenly see someone that has made $10 to $20 suddenly lose everything. Why? Why did that happen? Emotion. He was so excited. Oh, I made $10. Oh, I've made $20. You understand? And out of that excitement, he felt that I can make all the whole dollars in this market. And he kept on trading. And suddenly, what happens? He loses it all. So you must learn to control your emotions even when you are in the profit side. Because if you're controlling your emotion, you would know that, hey, I've made a lot of profit today. Why not I take a break? Okay. Or even if you don't want to take a break a whole day, you can actually decide to take a break for at least an hour or 2 hours. All right. Do not, okay, let me give you this trick. Do not celebrate in front of your or in front of the charts. If you're trading with your phone, don't celebrate in front of your phone. Keep your phone one side. Go far away, celebrate. Give yourself some time, like an hour or 2 hours, and then come back. Because when you are overexcited, you would keep trading. And that is when you see yourself blow off what you've won. And that is when it's going to deal with your emotions on the negative side. So, and if it deals with your emotions on the negative side, that's when you get angry and you be like, oh shit, I lost $10. No, I'm going to make it back by force. I'm going to make it back. And you want to fight the markets. You forget that this is just a digital thing. All right. It's a digital thing. So what do you want to fight here? And the more you fight it, the more you lose. So your psychology is important. Your emotions is important when in the markets. Okay. So why trying to find out why many traders become unsuccessful? I discovered that trading psychology is one of the important things, like I said. So to many boom and crash traders, okay, that are seeking for a profitable trading strategy, they seem to have this psychology problem. All right. So you need to learn how to deal with that first once you before you get into the market. So if they can find a profitable strategy, they will want to, they will succeed in Forex trading. All right. For that reason, they go sorting for different strategies. A lot of traders want to always get different strategies because they feel that, man, I can always get the holy grail. Now you need to understand this. There is no holy grail when it comes to trading. There is no holy grail strategy. There's no 100% strategy. Participant can now see your screen. There is no 100% strategy when it comes to trading. It is you that has to. It is you that have to create a strategy for yourself and build a strategy to be the percentage that you want. Okay, you will have to be the one to build a strategy for yourself and grow the strategy to become as strong as to be a strategy that, man, you can call it a holy grail for yourself. Because why? You are the one who created it, and you have done what we call the three main factors of strategy creation. One is what? Back testing. Two is sustainability, and three is what? Reliability. Number one, back testing. When you create a strategy, you want to make sure that you keep back testing it as many times as possible. I believe oftentimes you hear people who tell you, oh, I've back tested this strategy and I've seen many winning trades with it more than lost trades. You want to make sure that when you create a strategy, you back test it and make sure that before you can approve that strategy to be a good one for you, you want to make sure that that strategy has given you more wins than losses. More wins than losses. And when you are doing this back test, you don't have to back test with your real account. You back test with your demo account. So that's why you have a demonstrative account. So you want to run back test as oftentimes as possible. You want to run your back test, let's say like 100 times. At the end of 100-time back test, you count how many times were you in profit in between the 100 times. If between the 100 times you are in profit like 60 times and you are in losses like 40 times, you can give it a rate of 60% accuracy, and you keep back testing. Because the more you back test, all right, the more you get familiar with the strategy. And that's where we talk about sustainability. All right. The more you get familiar with the strategy, the more you can call that strategy a strategy that can sustain your trading style. All right. The more you get profitable with your strategy that you are back testing, the more it becomes a sustainable strategy that you can say to yourself, okay, this is one strategy that I want to be using every single day or every single time. Okay. So always make sure you back test until it becomes a sustainable one. And after it has become a sustainable one, you want to make sure that it enters into the category of being what? A reliable strategy. All right, a reliable strategy. So today, I will address some top secret which most boom and crash traders do not pay attention to, but it holds more than 50% of their success rate in the forex market. And now you might ask, what is that? Risk management. Risk management is very, very, very important in your trading career. If you want to be profitable, if you want to see yourself increasing every single day, if you want to see yourself quitting that 9 to 5 job and be at home trading with confidence, having money coming in to take care of yourself and your family, number one thing you must consider in your trading career is risk management. Very, very, very important. So risk management is a complex word on its own. It comprises of so many topics incorporated in itself. So a lot of professional traders rarely talk about it because it's one of the things, because it's one of the big hidden secret of successful trading. So a lot of traders don't talk much about it. They just take it as, man, let's just get into the market, buy, sell. Oh yeah, is being bullish now. Let's buy. No, you have to make sure that you have risk management in consideration. So in the words of risk management is the only validated, sustainable, and reliable trading strategy that never fails. Many would why would I say so? I know that's what some people would ask me right now. Why would I say that risk management is a sustainable strategy? The fact is that the result and solutions we seek tends to come from sources we belittle. You understand? We belittle risk management when we take trades. You see someone with a $50 account who would just get into the trade and open a lot size of 0.50, 0.60. Even sometimes you see someone with a $20 account opening the standard lot size of 1.0, 1.20. Why should you do that when you have a little account? You're not putting risk management in place. That's what it means. And that is why at the end of the day, if a spy goes against you, you blow an account and then it deals with your psychology. You just be like, hey, trading is scam. I'm not trading again. No, trading is not a scam. But you must also understand that trading also is not a game, because when you are trading the boom and crash market, especially, or even the forex in the forex market wide, when you are trading without risk management, you are automatically taking forex as a game. You're kind of like, okay, if I win, I win. If I lose, I lose. No, it's not meant to be if I win, I win. It's meant to be I will win. But if you lose, you get the courage to move in again because you have applied risk management. If you have $100 account, okay, if you have $100 account, and then you take, like, let's say a trade, you take 5 trades, and or let's say you take 20 trades, okay, you take 20 different trades with your $100 account, and you lose in let's say you lose $2 in 10 different trades. 2 times 10 is how much? That's $20, right? So let's say you lose $2 in 10 different trades. You've lost $20 out of your $100 account. Then what if, okay, let me even say that you lost instead of $10, instead of 20 trades, let's say you lost in 30 different trades. Okay, you lost $2 in 30 different trades. 2 times $30, that's gonna be how much? When you times 2 times 30, that's like $60. You've lost $60 and you have how much left? You have $40. You lost $60 in 30 different trades. Now, what if you have extra 10 different trades to take more? And then in those 10 trades, you won in those trades. And then you won, let's say, $5. No, let's say you won $20 per each of those trades. When you times $20 times that 10, that is you making $200. That is why risk management is important. That is why risk management is important. You lost in 30 different trades. You lost $2 in 13 different trades. $2 resulted to $60 loss. And then you won $20 in 10 different trades, which resulted to $200. And how is that even possible? So when you are taking your trades, applying risk management requires you to consider some certain things. One, how much you're willing to lose. As a trader, before you take a trade, you must ask yourself, how much am I willing to lose in this trade? Because when you don't know how much you're willing to lose, that is when, if you lose in the trade, it deals with you psychologically. But once you know how much you're willing to lose and you lose that certain amount, you're confident. You say to yourself, okay, I'm willing to lose $2. And the trade went against you when you took the trade and you lost $2, you'd be like, okay, how much I was willing to lose, I lost it. Let me go in. Maybe I didn't enter at the right place. Let me take a clearer view of the markets and take another trade. And in this trade, I'm risking 2% again, or I'm risking $2 again. If you enter the trade and you lost it again, you'll still be comfortable to go into another trade because you know that what you're losing is what you imagine within yourself, what you agree within yourself that you're willing to lose. The thing is that you're having this confidence that as you're losing this $2, you're looking for the perfect entry. And the right time will come when you will get a perfect entry that will give you a massive win. And this can only come especially when you have what we call your technical analysis or your price action in place. Trading the boom and crash market is not all about indicators. Buy when is oversold, sell when is overbought. No, it's all about you applying price action. If you want to be profitable in trading both forex, both volatilities, both boom and crash, price action is very important. So imagine when you apply price action, and price action tells you what the market is doing and what the market could do next. And then you also have your indicators with you, with your proper strategy. Imagine how profitable you can be in it. So in this training, you're going to learn proper price action, how to analyze your markets and follow proper price action in the boom and crash markets. So risk management considers the following: balance, equity, leverage, margin, free margin, lot size, risk to reward ratio, and trading plan. When we talk about risk management, these 8 things are very crucial. Now, what is balance? Balance is simply the amount of money or the capital in which you deposit into your trading account. So an increase or decrease on your account balance depends on your profit or loss after a closed position, right? Which ends in what? Profit. So we should know that your balance is how much you have there in your account. Okay? When you are in profit, how much you have left after you close that position is your balance. If you are in loss, how much you have after you close that position is what? Your balance. Number 2 is your equity. What is equity? Equity is simply the amount of money available for another open position. Your equity increases as your open position, your running trade is in profit, and it decreases when your open position is in losing trade. Okay, so your equity, all right, we are gonna be cut off very soon. All right, so your equity, you already know what that should be when you're in your trade. All right, when you're currently on a trade, you see your normal balance will be stagnant, while there will be another one below your normal balance that increases or decreases according to profit or loss of your trade. That is your equity. Okay, that is your equity. Another is your profit and loss. Profit is addition in balance realized from closed positions, while loss is subtraction in balance realized in closed position. Now the next thing is lot. A lot is the unit of measurement for any position size in all the foreign exchange market. Lot size is always standardized and calculated to suit an open position that a trader can take in Forex. So for instance, one lot size is called a standard lot, while two lot sizes is called two standard lots. Okay, when we talk about lot, that is when you're about to open your trade. All right, when you open your MT5 and you want to buy or you want to sell, the same place where you increase where you have 0.20 for your boom and crash. Okay, that is your lot size. All right, some people call it volume. Your volume, the amount of volume you use to take a trade. So if you hear someone say volume, it's also the same thing as lot size. Okay, so when you see 1 point anything lot size, that's known as a standard lot size. And when you see 0 point anything behind, all right, maybe let's say 0.1 or 0.2 is called a mini lot size. Okay, so 0.1 is a mini lot size, while 0.2 is two mini lot sizes, 0.33 mini lot sizes. Okay, so just take note that mini lot size is for anything behind the point. No, not necessarily anything behind the point, but the digits after the point is your mini lot size. All right, while your micro lot size is the digits after the digits after the decimal point. All right, so this is your 0.01, and you call it what? A micro lot size. Why? If you increase it to 2, you call it a 2 micro lot size. And then the last lot size we have is what we call the nano lot size, which is 0.001 or 0.002 to be 2 nano lot sizes. Now in the Forex markets, you can use a nano lot size, you can use a micro lot size, and you can also use a mini or a standard lot size, but it's not the same in the boom and crash market. In the boom and crash markets, the only lot size that you can find in the boom and crash market is what we call the standard lot size and the mini lot size. All right, the standard lot size and the mini lot size. That's the only lot sizes that you can find in the boom and crash markets. And why is that? When the boom and crash started newly back then, all right, there were nano lot sizes and micro lot sizes, but due to the ticks in the markets, all right, due to the ticks in the boom and crash markets, it got to be that before one can make $1, okay, before one can make $1 in the boom or in the crash market, having a nano lot size is gonna take a very long time, a very long time. And before you can even make $1 in a micro lot size, it's gonna take a very long time because the ticks in the boom and crash market are very, very little. You can compare it with the ticks in volatility or the ticks in the Forex markets. Okay, in the Forex market, 6 ticks can make a pip, can easily make a pip for you, but in the boom and crash market, it takes a lot of ticks to give you or to a pip. So that is why the broker had to swipe out the nano lot size and the micro lot size, and then made it standard to be made it a standard thing that it should be a standard lot size or a mini lot size to trade the boom and crash. So that is why, if you notice, you cannot decrease the boom and crash lot sizes to something like 0.10. No, it's strictly 0.2. So 2 standard lot size to trade the boom and crash markets upward. Okay, so you get to also notice that even with the 2 mini lot size, all right, is also very dangerous if the market goes against you. So as it is easy for you to make a pip, having a mini lot size is also easy for you to lose having a mini lot size. So it all depends on you. You have to learn to trade very well in a proper way. Let us move on. In the next 4 minutes, we're all going to be cut off because I've set this to 40-minute interval. So we're going to be cut off soon in the next 4 minutes. So once you're being cut off, just join immediately. Don't even let me post in the group say to tell you join. Just click the link and join immediately because it's going to start automatically. Okay. So leverage. So leverage enables a trader to take open, okay, bigger positions with a small amount of capital. When we talk about leverage, you have a $30, or let's say you even have a $10 account, but you see yourself taking a trade that a $50 or even a $100 account can take with your little $10 account. That is the power of leverage. Okay, so it is the broker that gives you the leverage to face the big market with your small capital. All right, that is the definition for leverage. Another is what we call margin. Okay, so margin is the equity in which a trader must deposit to enable him have an open position. Margin, all right, the amount you ought to have in your trading account before you can actually take a trade. That is your margin. And then we have margin call. Okay, a request for additional funds from a broker to a trader or an investor when open positions are running. Now you get to see, I believe, not even I believe, I know that a lot of you have blown different accounts, right? So you get to notice that when you are in a trade and then the price is going against you and going against you and going against you, you get to notice that suddenly the digits, all of them turn red. All right, everything turn red. That is what we call a margin call. Your broker is telling you, hey, you're running out of resources. You either add something or close up. Okay, that is what we call a margin call. Now, if you add more money while that trade is running, everything suddenly turns, your balance suddenly turns back. Your margin level and your equity and everything suddenly turns back blue. But if you don't add anything, it remains red, and suddenly your running trade will just cut off automatically. That is what we call a margin call. So it takes you off automatically once your equity, once your margin is out of resources, or once your account balance is not enough to handle the market again, it takes you off automatically. So that's what we call a margin call. So you always want to make sure that you're looking at the margin call to know when you need to know when you need to put yourself in order. So you always want to make sure you focus on your margin call. Okay, the next thing is what we call the free margin. Before I continue, I'm gonna cut everybody off automatically because this is gonna cut off. I don't want to start and the next video I will start talking about it again. So let me just cut us all off. Everybody rejoin.